where are we? So oil is still below 80, but that helped it from going lower. It's this is what we call renter rebel activity, actually. They start trouble just to, like, you know, delay oil shipments and cause trouble and make people concerned and drive the price up. So what was this? Craig Capital One shopping onboarding. Was I trying to buy? Was I trying to do something with Capital One shopping? Not that I know of. Set up awesome screenshot. Oh, that is useful, but not important. And here's Microsoft Edge. So here we go. This is my Bing box now. So see, you just talk to it, really. Don't be afraid to use these things. I mean, just be like, hey, oh, no, that wasn't me talking to it. You said, excellent. I said, oh, very important, though, if you want current information, you know, it's fine if you say, you know, how does solar radiation affect us? But, you know, if you want current information, you have to remind it what day it is. That's a really important part of communicating with this thing. So that's interesting. What else is going on? Oh, here, let's experiment with that. What else is going on in the market today, in the stock market today, that we should be paying attention to? Notice how he knows what I'm going to say before I say it anyway. Which is very interesting, though. It does predictive, you know, it does predictive thing, but you have to click the tab. I'm not that coordinated. My daughter does it great, though. Like, she, as soon as she sees the word come up, she's like, bit, bit. It makes her so fast as a typer. There are many things happening in the stock market today that could be of interest. Here are some headlines I found. Why this stock market gauge contradicts expectations for Fed cuts. Ooh, I like that topic. Why bears can't keep the stock market down despite the bad news, which is kind of the opposite. Stock futures slip as earnings flurry continues. Yellen on how the U.S. can bring down inflation while maintaining a strong job market. The stock market rally in 2023 has added $213 billion to the wealth to 10 people. 10 people made $213 billion. That's nice. How lovely for them. All right, here are some of the headlines I found. Oh, I see. These are all his sources. And this is the one that sounded interesting to me out of that group. Now, in theory, he's supposed to be able to summarize. If you click over here, see what happened? So when you use Edge, they're getting good at this. Get the best response, relative, blah, blah, blah. Get better news. What are the pros and cons? Pet vacuums. Rewrite, try searching. Oh, ask me anything. Here you go. Can you summarize this article? This is supposed to work, but I don't think it does. Ideally, though, this is what they're trying to do. Here's some tips on how to summarize. Now, okay, so in theory, it's supposed to be aware of the window it's in, and therefore it should be able to read the entire article. This is a key, though. You don't have to feed it in batches. It can read the entire article and summarize it for you. In theory, it doesn't actually work. Insights. What is this? What does that have to do with Bing? Compose. I don't know. Chat. So it doesn't properly hook up to the article like it's supposed to. But what's supposed to happen, let me put this away. So what is supposed to happen is in Edge, and now think about how cool this is. It'll be great if Chrome can do this too. So you're in Edge, you're reading an article, and you say, oh, that's way too long, I don't feel like reading it. Not this, of course, but it's too long, I don't feel like reading it. And you can just go bit, summarize it. So I think that's incredibly cool. I'm very excited about that feature. What is the article then? So investors penciling in pivot points. The volatility index, rubber right now rates in the market shows traders see 93% probability that federal cut rates. See, this is where they're wrong. 93. Why would they cut? It doesn't make any sense. And England just had 10.1% inflation this morning. So, you know, you have to realize, like, you know, that we had mitigating circumstances with the banks falling apart. England didn't really have that so much, and so that's what made our inflation look lower last month. But realistically, it's probably going to snap right back because UK inflation hasn't gone down at all. So hike in May is seen as 86. History shows the Fed tends to cut interest only when volatility rises quickly as a result of geographical shock or an imminent recession. I think we have that probably. As far as we're concerned, this is a real Fed put. The proverbial Fed is an ocean monetary policy. The VIX isn't offering any signs. There are exceptions, elevated volatility. Okay, nothing much here. This chart's kind of interesting. Visual search, what does that even mean? Tap here to select part of the image and search it. So weird, right? No, I don't want any of this stuff. See, they're you know, it's screwed up right now, but they're trying to integrate all these, you know, really cool features that are not there yet. Can I just make it bigger? No, I cannot. Okay, so what are they saying? The VIX and the Fed funds rate. So in other words, the VIX, which is, I assume, the black, has to be the VIX because the VIX was never down there. So the VIX is here, and what they're saying is when the VIX is elevated like this, I don't see that it really proves anything, frankly. So here's a, let's see, let's take it back a bit. Here's a high Fed funds rate, the VIX is high. Here's a low Fed funds rate, the VIX is low, is high, but comes down. Here's a high VIX fund rate, the VIX goes up. Lower Fed funds rate, VIX goes down. So they're saying there's a direct correlation. Lower Fed funds rate, VIX goes down. So in other words, if the VIX is going down, if you look at it the other way, if the VIX is going down, then that indicates the expectation of a low Fed funds rate. But there's not, I don't think you can really draw a conclusion from this. I think it's just it's an indication of times. I mean, basically, you want to look at a chart like this and say, well, what happens first? First, the Fed funds rate comes down, but the Fed funds rate comes down because you're entering into a period where something bad is happening. So first, volatility goes up, then the Fed funds rate comes down, then volatility goes down, right? So in other words, first there's a problem like inflation or a market crash. Then that causes the VIX to go up because the VIX is basically a measure of put activity on the market, relative put activity in the market. So then the VIX goes up, lots of people buying puts to protect and so on and so forth, or people shorting the market. And then Fed funds rate comes down because when there is a crisis, Fed funds rate comes down. But really, it's the VIX indicating a crisis when it's high. And that's exactly what just happened, is the VIX realized there's a problem long before the Fed really did anything about it. So the VIX is very quick to, you know, leap high. So the VIX is saying here, this is a massive, serious problem. And the Fed finally goes, oh, okay. And they zero the Fed funds rate. Wow. This is why people are freaking out about this kind of mortgage rate. This is not even that high. Look where we were back here. I mean, this is what? This is 2000. Here's 19. I think that's 90. I can barely read that. So let's say this is 1990 and this is 2000. So for that period all the way up until 2003, you know, we've seen 10%. This is a 10% line. 10%, 10%, 10%, 10%, 10%, 10%. Okay, since my kids were born, just this one time. Oh, and this is like they dropped it right after 9. Well, yeah, kind of. I mean, sort of, you know, basically 9/11 recession. They dropped rates. then the problem is that the housing market went insane. The VIX started rising because it was an unsustainable rise in the housing market, and it was starting to hurt the economy. The Fed went crazy trying to cool down the economy. Then the housing market collapsed, right? I'm sorry. Here's the Fed trying to cool off the economy. Get that mixed up. Fed's trying to cool off the economy. The housing market collapsed. The VIX goes crazy. The Fed goes to zero. Boom, 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 boom. And this is so my daughter's entire life. Both of my kids, born in 2000 and 2002, which is back here, they don't know anything about high interest rates. They grew up, this is what, 2008, right? So they were just starting. They were just in elementary school. And interest rates have been effectively free. Now imagine having that mindset when you grow up compared to, when I was a kid, we had our mortgage was 9%. We were lucky we had a 9% mortgage. That was a good mortgage. And you got a toaster from the bank. Banks made lots and lots and lots of money too. They don't still make lots of money. Anyway, so that's that news. So on the whole, we're just starting earnings season. Let's take a look at that if I can find it. Thank you, Mr. Bing. I'm done with you for the moment. Dave says Insights references the page you're on. Uh-oh, got to get back to that then. Microsoft Edge. What was that thing I was doing? Here are some of the headlines. Why the bears can't keep the stock market down before the bad news. Okay, so open this link in a new tab. All right. And then go to Insights, I guess he's saying. Insights. No. Oh, wait, was I on that tab? I was. Edit images. Why is that there? No, I wanted to go to this site. Maybe that's the problem. Let's get there first. Your browser has been updated. Next. Didn't we already do this? And then, and then it thinks, no, next. Browse the web. Next. Import. You're 3 steps away. Import data for improvement. Get your history, passwords, blah, blah. Stay in sync. Discover, I don't want to do that. Okay, all right, let's just try to open something. Thank you. All right, now let's go back to try this. So here and Insights. La da 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 da. Oh, it's telling about the U.S. Navy. It's not summarizing this particular article, but it does seem to see the article. So let's try this again. Please summarize this article. Damn it. Dave, got anything to say about this? Did not do what I wanted to do. This is cool. I mean, it's giving me more information about, did the Navy sail astray a drone? Oh, did it automatically summarize it? Oh, that's interesting. Q&A. U.S. Navy sails drone through the Strait of Hormuz, the boat, okay, fine, whatever. All right, that's a summary, I guess. What is this? Was this useful? Well, yeah, I guess. Page topics, drone, US Navy, then more stuff about drones and Navy. Related searches. Okay. Oh, that's interesting. All right, let's see what else happens here then. PhilStockWorld.com. All right, and we're going to go here. And are we automatically going to get insights? This is just kind of news about the site. Data is anonymous and aggregated from Bing. No, I don't care about the analytics. PhilStockWorld is a financial service. There's no summary of the article. How visitors found the site: 66% through the search engine, 34% through web pages. People also viewed. Why would they go to these things? That seems kind of weird, right? It seems like advertising to me. Kind of a 50-50. It's like it sees it, but it can't tell me about the article. Oh, nope, there's no chat. Okay, let's try it here. Welcome back. What would you like to do? Please summarize this article. Nope, we tried that already, apparently. Can you summarize this article? Nope. How about if I regenerate insights? Nope. China. Hello, my friends in China. Okay, well, nope, sorry guys. Still not ready for prime time, but it's fun. All right, good. Interesting. So what are we doing? Make that thing small, make this thing small. Let's see where we are. Let's go back to Chrome, which I'm much more comfortable with. I tried this Chrome extension called I forgot what it was called, but it was supposedly a ChatGPT type extension in Chrome, but it also had the same problem. It had no actual knowledge of where it was. Like, in other words, it would bring up a GPT box, but it didn't in any way, shape, or form have any context to what it was doing. It just basically, wherever you were in the thing, it was bringing up the GPT. It had a little dot. You can click on the dot, and ChatGPT would pop up. And so what? I mean, it's good if you don't have tabs, but I have tabs, so I just go like that if I want to get to ChatGPT. In fact, there it is. There's my baby. But the problem with ChatGPT and actually Bing, yeah, I know. Bing is worse. Because if you have a long article, it goes past the limit of what it can take. So now ChatGPT will be able to take this. Okay, so watch. And I'll say, please summarize and comment on. See, no problem at all. This article discusses the banking crisis and the actions taken by the government and the Fed to resolve it. What? Wait a minute. Well, that's not today. I'm like, I didn't say that today. That was last week. So Buffett's bet on the FDIC. The author warns this can't go on forever. The article provides an update on the CPI report. It's a critical view of the actions taken by the government and the Fed to resolve the banking crisis. The author suggests that these actions have created unintended consequences, such as devaluation of the dollar and inflation, and warns there will be consequences in the future. The article provides a good summary of the CPI report and highlights the differences between the headline CPI and the core CPI, which is important for investors to know. See, very educational. All right. But meanwhile, here's the thing. So if I say this to Bing, watch what happens. You're not Bing. You are. So we don't need that. Hello, Bing. Where'd it go? What is this nonsense? Okay, so watch. So I go, see what happens? It's going to be, it's cut off. So, you know, you can fit more text into ChatGPT. Bing is limited to 2,000 characters. And that is not that much. So that's why it's really important that this opening the text window thing, if it ever actually works, is going to be important. But anyway, I certainly trust ChatGPT a lot more to summarize my text. It's much better. It's much better at things like that than Bing is. But Bing is pretty good at getting you information when you want it. Where were we? PhilStockWorld, right? So now we're in the right place. So today we talked about, you know, my main issue with the S&P and with the Nasdaq, all the indexes is still value. You know, they're making less money than they were last year, but we're substantially up from where we were last year. So something is not quite right. Let's take a longer term view of this thing. Oh. I'll tell you what I'm looking forward to when there's an AI that when I look at the S&P, it's going to sync it across all my different things so I can look at everything at once, so that when I go to the chart, it's got the chart. When I go to I go to Yahoo, it's going to be on Yahoo. When I go to Stockopedia, it'll show me on Stockopedia. That would be very nice, right? If all my different screens and all the things I look at to analyze something at the same time were all sent to the right place, I would enjoy that. All right, so here we are. So this quarter last year, April of last year, well, we were higher. I guess we can't really complain, right? I mean, last year we were up here, and now we're going to make about 5% less, which is 200 points than last year. So, but the problem is last year wasn't justified, because after we report, see, the earnings that were reported last year, even though calendar-wise they were reported during April, right? So calendar-wise, they were reported during April, but what was the reaction to the April earnings? The reaction to the April earnings were we dropped pretty harshly at first. In fact, we dropped harshly, bounced back, and dropped again. So realistically, this line, 3,900, right, where we had trouble getting back over 4,000 for the entire rest of the year, the 3,900 line to the 4,000 line in that area, that's the zone that we deserved based on last year's earnings. But since then, we have had the last two quarters, this one is minus 5%, or is supposedly going to be minus 5%. And this one, wait, sorry, October. This one and this one, so from here to here are two consecutive down quarters. But overall, what you care about is minus 5% from last year. So how are we 5% higher than the generous top of the channel from last year if we're going to be minus 5%? That doesn't make any sense. So it's difficult to imagine how we're going to have better earnings. We don't know what the banks are going to be because they got bailed out so fast they didn't have time to report losses, which is, you know, good. I mean, that's the point of doing it. But I'm not sure that doesn't make everything better, right? It's like getting a blood transfusion. It's like, okay, you needed, you know, it's like, hey, good news, you needed 4 pints of blood because of the big hole that was shot in your body. It's not good news. The question has to be, did you fix the hole? Because you're going to lose 4 more pints if you didn't fix the hole. So you got to think about the causes of things and what's going on and what's happening. So anyway, so that's what I was bitching about today. Is I was a little bit concerned about that we're still not there yet as far as valuation matching where we want to be on the S&P 500. I don't know what that was. It's pretty loud. And yesterday, right? No. Oh, silly me. Oh, well, this isn't yesterday. This is today. That's my problem. Yesterday, we started talking about the portfolios. And this will be important. So, and don't forget, we got the Fed, the beige book comes out. Not the minutes, it's a beige book. So it's not really going to move the market much, most likely. So we got the portfolios, and I looked at the portfolio, and first of all we're doing now is shuffling things around. It's kind of boring. So I'm kind of into like cashing them out and starting again. We've been doing this since 2019. What is that? Why did you go into that mode? I don't like it. I wonder where that came from. So we've been doing this since 2019. It's really huge. It's got a lot of positions, and I don't think anybody's really getting a lot out of this at this point. It's just maintaining like a gigantic portfolio. That's just the long-term portfolio. Then we got all these guys. So as I started going through it, I'm thinking like, okay, it's time to like start fresh, and we'll get a whole new batch, and we'll start again, and we'll spend the next year talking about building a portfolio step by step by step. Now that's going to be boring for some people. Sorry, but I think it's good to get back to the basics and really talk about the fundamentals and selecting positions and so on and so forth. And you know, and we'll be in the fun position of being able to grab bargains whenever we want and say, oh, let's add that to this portfolio. Let's add that to this portfolio. All right, so maybe I'll start one quickly. Did I do that? I don't like doing that. Maybe we'll put a good amount of things in the LTP to start, and build the other ones up more slowly. I don't know. Got to think about that. Anyway, it's just more fun to start from scratch and to have a fresh portfolio. Maybe we'll start with $1 million. I don't know. What do you think? Well, that's an interesting thing. I never did that. It's the only thing I don't like. That's the only part I don't like. Is it's kind of boring. Just have $500,000 to spend, and I know that's, you know, not everybody has $500,000. But if you start with $500,000 to spend, it limits how many things you can buy, or, you know, leaves you in a fairly conservative thing. But that's frankly how we did start the LTP in 2019. So not even 4 years ago. That's what we did. We started it. We built it very slowly. We doubled it. We doubled it again. Doubled it again. And here we are. So anyway, so the review was of the yesterday was of the short-term portfolio. But anyway, so in doing this, I realized that we have to have these huge hedges to protect these huge positions and so on and so forth. And it's just, at this point, it's more tedious because I'm more worried about losing money than making money. And yes, we are making money. You know, the long-term portfolio made a couple $100,000 this month, but I wonder where it's up today. Let's see. That's interesting because we just had a little bit of a pullback. So now it's 3713. And yesterday it was, because I know I pulled the number. Ooh, see, 3782 yesterday. And the short term was 3904. So I say 82 to 13 is dropping $70,000. And the short term portfolio, well, I was just in it. That was nonsense. And the short-term portfolio, $3,897, so about 3.9. And that was 3.9 yesterday. So we actually did. We just lost 70,000 bucks today. So that's because I'm not sure why. Actually, it's probably because of the way the VIX moved. But anyway, so, you know, last month, you know, these things, they go up and down and up and down. But the point is to stay kind of balanced, and we're ready to take advantage of something. But we're going to be just as ready to take advantage of things when we have all cash, right? Then we can take advantage of stuff when it goes on sale too. And we're not encumbered by our previous choices. It's a little tricky though, because honestly, I mean, if I start a portfolio from scratch, it's like I want all these positions. You know, that's we're going to add all the stuff to the watch list. Anything we take off the portfolios is probably going to go on the watch list. There's really not like a lot of things I want to purge at this point. You know, but here we got, you know, and we have so much cash on the side anyway. We've got, what is this? Oh, that's a money talk portfolio. That's why it looks weird. It's not the short-term portfolio. So in the short-term portfolio, you know, we'll just start out with money for the money. The SQQ position is too good to not have. You know, if I think I mentioned, if you have 100,000 of these, I mentioned this at the end of this thing, just 100 spread without any margin requirement, right? Which is, and by the way, that's important because it's in the short-term portfolio. When we first start out, even though we have portfolio margin, it's still not that much that we can mess around like we do now. Now we can mess around with margin because we have, you know, a couple of million in cash. We got tons. We got $5 million. You know, well, more than 5 million in margin. But when we start out and we're back to $100,000, we can't take chances like this. But what we can do with $100,000 is take a this spread, the list by blah 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 blah. Oh, I see. So it was the spread that we have. So it was $65,000 for $600,000 worth of protection. Oh, I could have done the math myself. So this spread here, right, is net. Oh, the 30-90 spread. I wouldn't do the 30-90 spread. I'd do like the 30-70 spread. But the 30-90 spread is only net $5, right? You can see that. This is like a little 520, let's say. So it's net 520, but it's a $60 spread. But we don't need protection for $60, and NASDAQ's not going to get there. So, but the point is, you can get a massive amount, $600,000 spread for $65,000. That's good. So we'll build things back up, and that's more to the point. I want to be able to, go through the logic and talk about that stuff. So in the money to our portfolio, we didn't make any changes, right? So that just stay the way it is. In the short-term portfolio, these short puts are all just offset. So if the market does not go down, then we will collect. I mean, assuming nothing particularly bad happens to these particular stocks, but if the market just does generally okay, we're going to make 24 plus is 34 and 44 and another 5, call it 6. So 40 is about $50,000 here. So we sold $50,000 worth of short puts, and that helps pay for more of these. And that cash then gets used here. So we sell these, if you know, in a vacuum, we sell $50,000 worth of short puts. We buy $50,000 worth of this protection, which is 100, and we have roughly $600,000 worth of protection for zero. We spent zero cash. And what's the binary? The binary is either the market goes down and we're going to make up to $600,000 on the spread, or the market goes up and the money we spent, which was only $50,000 or $60,000, is paid back by these guys. And that's our first hedge. We can't afford that because of the margin requirement on this won't let us afford it. Even if we use the LTP's margin, it's still going to be, these are kind of expensive. I'd have to find less expensive things to sell. So in other words, because this portfolio, if it's only $100,000, can't sell 10 $100 puts. That would be $100,000 right there. And even with portfolio margin, that's not going to cut it. All right, so we, and that's what happens with any of these positions. But we're sitting on $3 million of cash, not even $2 million of cash. We're sitting on $3 million worth of cash in this portfolio. So I don't care if I get assigned some Generac puts, some Generac. But it's going to be very different construction when we start out with fresh money. Anyway, so that's why we sell short puts, to offset the potential losses. Then we look at a spread like FAZ is a basic bull call spread, but we're imbalanced. Because why? This is the area we're worried about the most. We have 100 longs and we have only 50 puts. So what did we do because we have 100 long and 50 puts? So let's turn this into an income producer. We're going to roll the 100 calls to the 2025 calls. We're going to sell the 40 calls on top of those at net 220. So we're spending very little money to do that. We're going to buy back the short 30s that exist now. So all we have, what we've really done though is we had a half uncovered 150 spread of that expires in June. We're rolling that to 2025. So we're buying 18 more months of the spread. Rolling to 1825, we're fully covering it, but doubling the spread. We're widening the spread. It was a $9 spread, and we're turning it into a $20 spread. And FAZ is it's at the money basically, so it's 20 at the money. So we're taking our $9 spread, we're turning it into a $20 spread, so it's fully covered at 100. And because we now have $200,000 worth of protection, I hope I said that somewhere properly. But because we have so now we have $200,000 worth of protection, as opposed to $90,000 we had before. We are selling 60, so we're selling 60% of the spread's value of the July 22 call. So now this is more like a butterfly play where we've got the long, which is going to be the 2040 spread, covering the short June calls. Now, in theory, if FAZ goes up sharply and we don't have, we should be able to roll those calls to a short 120 or short 100 of a much higher strike. That's just the way the FAZ options work. So that's our planning ahead, is what we're going to do. That's why we only sold to 60. You always want to leave yourself an out. It's very much like playing chess. So what will you do if you're wrong? So in other words, what I think is, I think the banks are not in that much trouble. I'm not expecting too much blowback. And I don't think the FAS is going to go much higher. Plus, there's a decay issue with FAS anyway. So it tends not to go that much higher unless there's something very seriously changes. I think it's already baked into most of these banks right now, and it's going to be hard to shock it even lower. If I'm wrong, however, and FAS does now suddenly spike up because the banks go even lower and something is seriously wrong, then that's how I determine not to sell too many of the short calls, because 60 can be rolled to 100 and it's a pretty forgiving roll. In fact, let's take a look at that. So we have the spread. FAS is at 20. We're selling the $22 calls, but these 100s are going to keep up with them for quite a long time. It's not going to be that effective. But let's say the July 22 was July, right? The July 22 calls are now $1.60, and I got 60 of, we sold 60 of them. And if we have to roll them, let's say we have to roll them to October. So what in October is $1.60? Well, to start with, clearly the 30s. So I know I can roll them up to 30. Now it's pretty relative, but you can even check. You can say the delta of the October 30s is 30. The delta of the July 22s of the July 22s is 42. So these will gain 12 cents more than the ones I want to roll it to. So it won't be a perfect roll, but I've only got 60 and I have 100 longs, so I think I'll be okay. It's very unlikely, because let's say I did 120. Well, then I could roll to whatever is 80 in October. And what's 80 cents in October? Nothing. You can roll to the 38s. There's nothing at 80 cents in October. So it's very unlikely I won't be able to roll out to a higher strike that's going to give me a significant margin of safety. Then I go back to the question like, well, okay, that sounds good. How much did FAS actually move in the recent fall? And so FAS had only been as high as 24, and it started way down to 16. All right, so FAS only made it to 24, and it took it 2 weeks. Let's say 2 weeks. It took it 2 weeks in March to get there. Let's say a week of intense jumping. So it went from 16 to 22 to 24. Let's say that's 50%. So 50% in less than 2 weeks, and more like 1 week would be the worst case scenario. Hopefully, would be the worst case scenario. But that's, what's going to be that shock again? How are we going to suddenly go, oh my God, it's even so much worse than we thought? Probably not. So I'm looking at this and saying, I feel pretty comfortable that I'm never going to use that roll to 38, right? 38, it's up here. I don't think that's likely. But not only that, also, we have, again, $3 million of cash on the sideline. I can always buy 100 more longs. It's not, this is not going to be a position that kills us, so we can afford to mess around. So the way we changed it is we changed it to this bull call spread. Where am I? So we changed it from what it is now, because I'm risking this money. I could totally lose it. We already lost, 23 minus 7, 16, right? So we already lost about $16,000 on it. I want to make that back. If FAS doesn't get well above 21, I'm going to lose all of it. So instead, we're turning into a much, and by June, by the way. So we're turning it into it was June. So anyway, it's a little, oh no, think we decided it was June, or did we do July? Doesn't matter. It's only pennies off. So we changed it to a wider spread, a longer period of time. We didn't spend any money, so we're still at the same net $30,000 basically that we started. We didn't really spend any money to move it. And now we moved it to a spread where we're selling the short $22 calls for, where'd it go? Oh, it doesn't say there. That's right. So we sold the short $22 calls for 180. Oh, no, it wasn't July 22. That's why I'm getting confused. Okay, we bought those back and we sold these. So we sold the July 22 calls for $1.80 yesterday. They're already down to $1.65. And that brought in $10,800. Don't forget, so we have an original $30,000 spread. We sold July, which is conveniently, it always tells you in Thinkorswim, 93 days. So it's 93 days out of our 600 days. So we've got a good 7 times that we can do that sale. So if I've got a $30,000 hedge and I'm able to 7 times sell $10,000 against it, that's $70,000. If we're successful, if we're even half successful, 7 times selling short call premium against the spread, then the spread is paid for and the hedge is free. So that's what I mean by getting the money back. And also, it's like hedging your hedges, right? So it can't both happen. If it goes up, we're going to make money on the hedges in the back on the backside up to $200,000. We only sold 60. So unless it goes up, 60 is 6,000, right? So times 3. So unless it goes $3 over the strike of the short calls, and then we get to roll it anyway. But unless it's $3 over the strike of the short calls, we're over covered with our 200,000. But what we don't have is a hedge, because obviously if it does do that, then the hedge is ineffective. That's why I didn't count it as downside protection, because I said, okay, this has turned into an income play. But given that the banks already failed, we had FAS because we were worried the banks would fail. Given the banks did fail, and that they didn't fail as badly as we thought they would because the government stepped in and fixed it pretty fast, then there's no reason for us to be panicked about it. Oh my God, it's almost time for the beige book already? All right, and some other stuff. So coffee, we knew coffee was going to go up, and it went up, and no big deal there. TZA is a hedge. We're keeping it the way it is. Coinbase is fighting with the government. It's really tricky about these guys. It's like it has so much upside potential. Nobody believes in this. I got to point this out. Coinbase is we have the long 40s and the short 65s. It's at 67, or it was yesterday anyway. So it's at 67. We sold the $50 puts. It's at 67. All right, so that's Coinbase. It's still holding 65. So if we hold 65, which was our goal, and that's in 18 months from now, more than 18 months from now, it's a $125,000 spread, and the current net on it is $21,000. So what's going on with Coinbase? Government regulation. The government is sort of looking into regulating these changes, regulating the cryptocurrency, so on and so forth. It's all very tricky. And this is what happened when crypto sort of failed recently, right? Crypto went down with everything else in March. And this is what happened to Coinbase. It was down to 50, which is the bottom of our range. But zoom back up. Now it's back down because they're worried about government regulations again. It'll hopefully at some point, but the FTX scandal is what killed them, right? Because that happened last year. So they were doing great. Then the FTX scandal. And I think we jumped in, let's see, November, yeah. So we had the short puts on Coinbase. We already liked them that much. We had the short puts. But in November, which is early, we were early down here. But this is where I fell in the value. I said, down here is where I said that we're going to make a stand over here and take a big position. And we bet that it would get resolved eventually. The Coinbase was not like FTX, and they're not. They're in the US. FTX was in the Bahamas specifically to avoid the regulation that Coinbase is now saying, oh, give me a break, because now they're changing the regulations. And Coinbase is like, dudes, we're going to London. And that's the other thing that people don't understand about it, because everybody's betting against Coinbase. It's like they don't have to live here. You choose to domicile in the United States as a corporation. I mean, no, you don't really choose that if you're McDonald's and your fast food places are in New York, or in New York in America. If you're Kentucky Fried Chicken, whatever. But Yum Brands even opened up in China. They have a China division too. If you service in America and you need your people to be in America, that's one thing. Coinbase doesn't need that. They're an exchange. And I'm sure they talked to their top 100 clients, and the top 100 clients said, no, we don't give a crap if you move your offices to London. And if you fall under British banking regulation, we trust British banking regulation. And the British bankers are very happy to tell Coinbase that they're never going to do this shit with that. Our government is chasing people out. It's just, you can't just keep changing the rules. And honestly, I'm not a big fan of crypto. I think Coinbase is going to survive because they don't invest in crypto. They just help people trade it. People are going to trade crypto. That's going to happen, whether it succeeds or not as a currency. People are still going to trade it. So I believe that Coinbase will be a survivor in the industry, and the industry is getting weeded out. But you're going to regulate them out of existence so they can't function in the US. They got to go overseas. They got to leave. But they're fighting right now. I mean, they got the lawyers, and they're doing everything they got to do to fight and keep these regulations off their back. It's so weird in this country. It's like, you don't know. It just depends on who's in power at any given moment, whether or not your business functions. That used to never be the case. That's why the reason companies like to be in America is because we were used to be consistent and steady with our laws and very, very reluctant to change things. Now it's like the whim of whoever controls Congress gets to change all the old laws and make new laws, and then the next people come in and they change all the laws back. It's insane. All right, so DIA also is selling puts. SQQ, we kept it. We're happy with the hedge the way it is. Oh no, we didn't keep it. Sorry. We just the short calls that we sold were dead, pretty dead. There's 7,800 left, and so we took the 7,800 off the table, and now we're selling September short calls. Same logic as TZA, except we have more coverage on the SQQs. So that's still our principal hedge, and it's a couple of $1 million worth of hedges in the SQQs. None of this matters if we cash it all out, but conceptually, that's how it works. All right. Beige book, right? Let's see if we have any pending comments or something like that. Nope. All right. Beige book. Fed. That's the minutes. Interesting. Think about how much we talk about the Fed, right? Jeez. We have, in the last 3 weeks, we had the actual Fed announcement. When was that? I don't know. But there's a beige book. We have the January 18th beige book. We have the Fed announcement. Then we have the Fed minutes. It's a lot. Oh, the beige book. Okay, now, here's where you get into the annoyance of the content limitations. But let's just see if we can get a good summary out of this thing. All right. How much? It's not that much. Oh no, it's not really that much. Because then it gets into the nitty gritty of the cities. It used to be so much bigger. Okay. Nope. Oh yeah, that was the right place to start. Wait, what? No. They changed the format again, you bastards. You're kidding. Oh, national summary. I get it. Ha 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 ha. We cracked the code. What the frick? What have they done? Oh, I am kind of stunned. They have really shortened the beige book to being nothing. I don't know what the hell this is about. You think it's because we were in the banking crisis and they just sort of skipped it? Stop that. Okay. It is April 19th, 2023, and the Fed has just released the beige book. Can you please read it over and summarize it in context? We are very concerned about whether the economy seems too hot, too cold, too hot, too cold, or just right, as inflation has been a big concern, and the Fed has their funds rate at 4.75%. It has a fund rate of 4.75% and seems likely to hike at least once more to get inflation under control. Could have read it by now because it wasn't that long, but more important, practice with my chat GPT because it makes things much better in the long run. Okay, so according to the beige book released by the Fed on April 19th, the overall economic activity has been little change in recent weeks. 9 districts reported either no change or only a slight change in activity this period, while 3 indicated modest growth. Expectations for future growth were mostly unchanged. However, 2 districts saw outlooks deteriorate. Consumer spending was generally seen as flat to down slightly amid continued report of moderate price growth. See, that's not good. Consumer spending was flat or down amid continued reports of moderate price growth. Manufacturing activity was widely reported as flat or down, even as supply chains continued to improve. Transportation and freight volumes were flat to down. On balance, residential real estate sales and new construction activity softened modestly. Non-residential construction was little changed, while sales and leasing activity were flat to down. Lending volumes and loan demand generally declined across the consumer business and loan types. Employment growth moderated somewhat in this period, and several districts reported a slower pace of growth than in the recent beige book reports. Wages have shown some moderation but remain elevated. Overall price levels rose moderately during this period, though the rate of price increases appeared to be slowing. Contacts noted modest to sharp declines in prices of non-labor inputs and significantly lowered freight costs in recent weeks. Nevertheless, producer prices for finished goods rose modestly in this period, albeit at a slower pace. selling price pressures eased broadly in manufacturing and servicing sectors. So, now, please take into account that there was a bank crisis in March that panicked the markets for a couple of weeks, but the FDIC and the Fed backstopped it, and people seem calm at the moment. Given all that and the beige book reading, how do you think the Fed is likely to respond at the next policy meeting? Based on information, it seems the overall economic outlook remains positive despite the recent bank crisis. The fact that the FDIC and the Fed were able to backstop the crisis and restore confidence suggests the financial system is resilient and able to weather such shocks. However, the Fed is likely to monitor the situation closely to ensure that there are no lingering effects in the broader economy. In terms of policy response to the next meeting, it will depend on specific details and how it has impacted the overall economy. If the crisis is contained and there are no significant knock-on effects, the Fed is likely to maintain its current stance of accommodative monetary policy. This means keeping interest rates low. See, she's relying on, he's relying on old information. That's no good. And so if I wanted to, I'd go back and forth and try to get him back on track. This means keeping interest rates low and blah, blah, blah. However, if there are indications the crisis has caused more significant impact, the Fed may need to reassess its stance and adjust its course. In this case, it would consider raising rates or tapering its asset purchase program earlier than expected. See, it's already done that. So that's where it's very, it doesn't understand what's happening. Overall, the Fed's response will depend on how the situation unfolds in the coming weeks. All right, that was not that useful. Now we'll go back to the full report. Prices. Oh, prices by district. Okay, that's a good idea. Here is the beige books section on prices. What is your overall take? And again, now see, this is the problem. She doesn't know this stuff, or he does. Why do I keep saying she? So it doesn't matter. Just for some reason I got a she mode now. So he doesn't know this stuff, and he doesn't take into account what happened. And it's so important to think of it in context. They did this beige book reading by talking to people about what they felt. And when they do this, a beige book study, and again, do you know this? Oh, I should ask that. Do you know how they do a beige book? They call up their buddies. The Federal Reserve governor of a certain region calls up his pals who run companies in the region and says to them, how are things going? What do you see about prices? What do you see about labor? They got a little checklist and they fill it out with their friends on the phone. It's a very informal system. This is not a professional survey at all. We put way too much emphasis on it. So they're talking to people in April who just survived the banking crisis. They're probably relieved. But you got to take into account that commerce slowed down in March because everybody was freaking out that the economy was collapsing again. So you're going to skew a lot of these readings to the downside, and it doesn't really, say rail traffic slowed. Yeah, well, the banks stopped lending money for a couple of days. It was really hard for people to get loans and move stuff forward, and people's credit lines were getting cut off for reevaluation. It's not normal. And it's, frankly, it means everything you hear in this report is subject to interpretation. And the machines are not capable of doing that. They're not going to understand all that. You can't, they're not going to be aware unless you tell them. They're not going to be aware of all this stuff that goes on. Overall economic activity was little change in recent weeks. 9 districts reported either no change or slight change in activity, while 3 indicated modest growth. Consumer spending was generally flat. Auto sales remained steady overall. Whoa. Oh, network error. That's weird. With only a couple of districts reported improving sales and inventory, manufacturing activities widely reported flat or down. Transportation and freight volumes were also flat to down, according to several districts. On balance, residential real estate, new construction softened. Non-residential construction was little change, while sales and leasing activity was generally flat to down. Lending volumes and loan demand generally declined across consumer loans. Like I said, several districts noted the banks tightened lending standards amid increased uncertainty and concerns about liquidity. Obviously, the majority of districts reported steady to increasing demand for sales for non-financial services. So underneath it all, there was still a good amount of demand. Agriculture conditions were mostly unchanged, while some softening was reported. Regarding labor markets, employment growth moderated somewhat. Several districts slower growth. A smaller number of firms reported mass layoffs. They were centered at the subset of the largest companies. Some of the other firms opted to allow financial attrition to occur and hire only critically important roles. Wages have shown some moderation, but remain elevated. Oh, Jackie got her internship for Chubb. She's going to the insurance game. It's not really the insurance. She's going to do an internship for their small business unit. They're trying to build up their small business division. And so she's going to be working with a team that's going to establish a web presence for them and improve their marketing and so on and so forth, and social media presence and all that stuff. So that's going to be her summer internship. And she said it was a pain in the ass. A lot of her friends are having trouble getting internships. The majority of districts reported say, okay, labor markets, right. A small number of firms reported mass layoffs, and those were centered in the subset of largest companies. Some firms opted to allow financial attrition to occur and to hire for critically important roles. Wages have shown some moderation, but remain elevated. Several districts reported declining needs for off-cycle wage increases compared to last year. Some moderation elevated. Districts reporting needs for off-cycle wage increases compared to last year. Right. Okay. So in other words, off-cycle wage increases means not your regular schedule. People are saying, I'm not waiting till frickin' Christmas, so till my year's up, I need a raise now. I can't afford to live. That is the story of the economy, and that is why the Fed is totally unable to, without throwing us into a massive recession, the Fed is not going to get inflation under control. And this is where everybody is wrong. And we talked about it a bit today, or was it yesterday, whenever. We talked about it a bit with the Fed. But the point is, I've said this many times, and this has been my whole premise for why inflation is going to be much worse than people think, is it's simply a matter of the fact that we've been underpaying workers for years, for decades. We're underpaying the low-level workers. And I mean the bottom 50%, not like just poor, not just minimum wage people, but like the bottom half of the working force is severely underpaid. And when the amount of inflation we're having now, I don't understand how people don't get this. You can't have house prices go from 180,000 in 2007 and that was ridiculous because that was already where it peaked out and crashed. But since then, because we threw money at the problem, because our solution was to give money to rich people so they could buy more houses, and they did. They bought up all the rental property, right? So now there's no rental property, and we're forcing poor people to buy houses they can't afford because the rents are so insane. It's so this, the seeds of destruction were laid back in the last crash, but for a decade, we've had those incredibly low interest rates. So wealthy people have snapped up properties, especially multifamily properties, turned them into income producers. They jacked up all the rents, and we're forcing, and now we force people into these houses. It went from 180, which was outrageous in 2007. It's now 340, almost 100% increase in 15 years in the price of a home. And it's not just the home. The taxes are up. The property taxes, the school taxes, you guys know this. You live in the world. Every town, every county hasn't got enough money. Inflation. So that's up. The cost of gas is up. The cost of the car is up. The cost of the medical care is up. The cost of the school is up. People can't afford to live. And these are people, the bottom 50% of the people in this country, as an entire household, as an entire family of 4 people, make $50,000, $55,000. How the hell are they going to afford that? How the hell are they going to afford that and retire? How are they going to afford that and send their kids to school that costs $50,000 a year each? $50,000 a year each. That's $400,000. That means you get married, you got nothing, you have kids, you got 2 jobs so that you can make maybe, let's say, if 2 jobs, you make $75,000 as a couple, right? You get 2 jobs, make $75,000 as a couple, but you need $400,000 for college in the next 20 years. You got 20 years to save up $400,000 to put 2 kids into school. So that's 20,000 a year has to be saved of your 75,000. Your take home is, let's say, 60. So 1/3 of your money has to be put towards saving for college. That's right off the bat of your after-tax income. That leaves you $40,000 to live on with 2 kids that are growing. It's ridiculous. It's just not realistic. And then the college cost. And by the way, that's also total nonsense, because then the college cost goes up every year and becomes more and more and more. So by the time you are paying, it'll be $100,000 by the time they're 20. So the money you think you're saving for college is not going to be adequate. So people can't afford to live. So they're going to their bosses and they're saying that's what off-cycle wage increases are. They're going to their bosses and saying, I need money now. I cannot afford to drive to work to do your stupid job. It is really insane out there. Let's see if he regenerates this response. Loaded. He's going to give it another shot. Uh-oh. Uh-oh. People are figuring out Kathy Woods does not know how to pick stocks. That's not good. Wow, look how slow he is. That's frustrating. Bing is slow today too. I guess they're redoing the whole thing probably. They're probably updating or doing something. Wow. It's been a while since it's been this slow. All right, so while we're waiting for you, let's say, what is the median income per family in the US? $70,000 for a family. See, Not statistically different from 2020, lower than 2020. Median income can also be adjusted for inflation. Using this method, it decreased by 2.9%. Adjusted for inflation, household income can also be close, blah, 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 blah. Okay. What is the, I want to say median or average? Well, it's median family, median income. What is the median income home price? Half below and half above in the US. Oops, didn't spell it correctly. He knows what I mean. Yep. Wow. How can you, the range is 334 to 467. How the hell can you possibly afford that? Half the home sold, blah, 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 blah. Also change though. Yeah, no shit. Okay. Can you please give me a chart with the median home price and median family income each 10 years from 1950 to say 1940. Let's go crazy. 1940. No, it's from 19. What year are we in? 1920. 1923 to 2023. Oh, hey, left poor Warren doing his thing. Was this response better or worse? Well, it was kind of shorter, wasn't it? Well, overall, the Beige Book reported in case the U.S. economy is a little changed. 9 districts reported consumer spending is generally flat, down. Some districts wages have shown moderate but remain elevated. Prices increased moderately. Price of increases, however, consumer prices generally increased due to still elevated demand as well as higher inventory cost. On balance, residential real estate sales and newly construction activity softened modestly. Non-residential construction was little change. Leasing activity was generally flat to down. Agriculture is a very, very different response, right? That's interesting. Oh, and it erased the other response. Wow. Oh, I didn't know it did that. I don't want to say better. No, I'm inclined to answer. I don't want to say any of those things because I worry about like the effect of what I say on its future responses. Where were we? Oh, thank you. Look how cool that is. Look, he decided like it was. He decided to do it from the every 10 years. I was wondering about that. Wow, I did not realize it jumped up again so much. So here's the thing. 1,500, 3,300, right? So in 1920, it was 2-year salary to buy a house. 2-year salary. In fact, here, now look, the salaries are going up faster than, you know, because this is 3,000, right? So it's just under, but here it's just exactly double. So it actually improved here. Here, they both went down a bit, so it's oh, that's the depression. So here's the depression. They both went down a bit. All right, but actually home prices dropped more because 3,400. So now it's less than 2-year salary to buy a house in 1940. This is when my mom was born. Here we're at 33 and 73. So by 1950, it was climbed over 2 years. It's 2 and a bit. So 33 is 66, right? It's quite a lot more. It's 20% more than 2-year salary. Here in 1960, when we were born, or when I was born anyway, it's 56, and that would be what, 11.2. So it improved a bit for the median family, and it was just over 2 years' salary to buy a home. Here, we're back to that 20% gap, right? In the 70s, it got a bit more expensive to buy a home. It was 220% of your salary, basically. In 1980, it accelerated a bit because now it's 47. It's 230% to buy a home. In 1990, and remember we had the savings and loan crisis in between here, right? In 1990, it was, this is 70 and this is 80. So we're still at like 225% to buy a home. 2000, when my kids were born, when I bought a home in 1998, 50,000 and 119. So that's like 240% of your salary to buy a home. Doesn't seem bad, but it creeps up pretty fast, right? This is how insane it's gotten. 240% in 2000. This is 300 is 180, right? So 180 plus 40, 360%. From 2000 to 2010, market crash and this is after the crash, after the housing crisis. 2000 is 200 and what do we say? 240%, right? So is it? No, 200, yeah, 240%. So 240% in 2000. 360%, 240 to 360 in one decade. Unprecedented. Unprecedented. And now 67, I gotta get a calculator for this one. So now 329 divided by 67, 491%. Okay? Our lives and our parents' lives went from 200% to 240%, even when my kids were born, 240%. Now it's 500%. My grandparents bought their first house in the 20s, or probably not even the 20s, probably in the 30s. My grandparents bought their house, it was 2 years' income. My parents bought their house, it was 2 years' income. I bought a house, it was 2.5 years' income. My child, right now, if she was looking for a house, 5 years' income. Unobtainable. So this can't continue. Can't, not sustainable. So either wages have to rise pretty drastically, or home prices are going to collapse. Those are the two possibilities. The possibility of having to pay 5 years' salary to live in a home is not sustainable. Okay, if you're buying a home now and you have children, expect them to be coming home. expect them to either never leave or to come back if they're out now. This is so unrealistic. All right, so this is just absolutely insane and unsustainable, and it means it's going to collapse. You know, things are not, it's like a Jenga tower when you're playing like at the end of the game and you keep removing pieces and you're like, oh my God, I can't believe it went this far. But you know it can't last. Maybe it goes 3 more blocks, 4 more blocks. You know it's going to collapse. You have made a very unstable tower that is going to collapse. It's not, And of course, that's the game, but that's the game of capitalism too, right? You extract as much money as you possibly can out of the people who participate in the game until the system collapses, and then you do it again. And that's where we are now. We are at end stage capitalism. You have completely screwed people out of the ability to buy a home. You've made it unrealistic to buy a home. And you could do the same chart with college costs and medical care too. It's not just a one thing. Everything is like this. People cannot live. And that's why the Fed, no matter what they do, are not going to be able to stop inflation. It's not realistic because these wages are so far below something as basic as the price of a home. And not only that, but I mean, remember, it used to be that you would buy a home and you didn't pay, you paid a little bit of money in tax to the, for the land, but it was your land. But you don't buy your land anymore. You buy the government's land, and the government is going to just charge you whatever they feel like it for you to keep your land. And if you don't pay them, they will kick you out. When the hell did we agree to this? And if it wasn't for these insane taxes, home prices would be a lot higher too. Because it's not just because in addition to these incredible prices, if you look at the amount of money taxes have gone up on homes, and of course the taxes are based on the valuation. So when the home is valued at some ridiculous amount, that makes everything that drives everything higher too. That drives your taxes where. So wait, where are we now? So we're at the salary thing. We asked about that, right? $70,000. We got a salary jumped up, right? Because it was well, it was 67, now it's 70. That's not much, but at least the salary came up to at least the median came up to 70. So let's take 334, 460. Let's just add 50 to that. Let's call it 384. So 384 divided by, what was that number? 71. Yeah, I mean, I'm going to be generous. I'm going to say, I'm going to round down there. I'm going to round up here. Oh, 540. You realize that's 10% more in 3 years. That the ratio has gotten 10% worse in 3 years. That means it'll be 30% worse. It'll be what's it going to be? It's going to be 546, 6.5. So at the end of the decade, it'll be like 6 times salary. So and then by then my kids are going to have to live somewhere. 6 times your salary. It's not even, and the rates are going up, and the interest is going up too. That's the Fed's solution to this, is to raise interest rates to make it even more expensive to buy a house. But who doesn't care about that? Rich people. They don't care how much it costs to buy the house. They can afford the house. It's the poor people who can't afford the house, so they're having to abandon their homes. They're having to sell their homes and go elsewhere and do something else and find a cheaper place to live and migrate somewhere. Fortunately, if you're a citizen, there's a lot of country to migrate to. But you can't live here. You can't have a median income and a median house at the same time. That's not even possible. There's a horrible mess, people. Not good. Oh yeah, I want to talk about the English inflation. All right, what else we got here? Got some questions. We'll talk about that first. Questions from Phil Solomon. What does Phil Solomon say? Is that the result of the crazy money printing that has been unleashed? He asked that at 2:30. It's 2:38, so therefore I'm sure you're talking about what I'm talking about. Yeah, I mean, we had a housing crash in 2008 because of speculators, because of really stupid speculation by the banks and by wealthy people who were bundling mortgage securities and trading them like poker chips. And just basically just doing all this bullshit accounting and all sorts of stuff. And so the price of homes was going up, and what was happening is that they were jacking up the price of homes. They were encouraging people to use the inflated price of their homes like an ATM. So people were drawing out the value of their homes. So they had built up equity in the home, but then they put it all out and pushed it into the economy, and everyone was being encouraged to buy another home, buy a bigger home, blah blah blah, whatever. Remember the real. If you're my age, I'm 60. If you're my age, you've certainly heard from a realtor you should buy as much home as you can afford because it's the best investment you'll ever make. That was a very popular expression back in the 2000s and the 90s and the 2000s. Buy the most home you can possibly afford. This is the best investment ever. It never goes down. It's blah 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 blah. Whatever. And honestly, they're right. I mean, if you look at that chart over 10 years, over 100 years, it never has gone down. A median home has gone up every single 10 years. Maybe at some point it went lower, but doesn't sustain down. But that doesn't include the cost of owning and maintaining the home. It doesn't include the fact that it doesn't include the fact that when you buy this big home and you pay these big taxes and you pay these big maintenance charges and you pay the big heating bill and the big cooling bill and you pay the cleaners and you pay the yard people and all this other crap that goes on with a house. So when you do all that, you're not saving for your retirement. You're not investing in the market. You're not building wealth. You are just living to maintain this house. And God help you if that house loses value and you end up with a negative investment or even a flat investment because you had all your marbles in the house. And that's what it was. And that's what happened in 2008. People were shocked that their home prices dropped, 30%, 40% all around the country. So now the home prices are back up, but where are you going to find buyers? Where are you realistically going to find people to buy your home for 6 times what they earn? Realistically, the bank shouldn't even be approving something like that. A loan like that is never going to work. You can't sustain that. So this is a very, very bad system. So anyway, so the first crash in 2008, what did they do? They bailed out not the homeowners. They didn't say to the homeowners, let's fix your equity. And when we had the crash in 2008, I was actually invited to meet with Geithner and Company. I was one of several people who was invited down to there, and they asked my opinion on what should we do. And I said, my solution, and it wasn't like a just question. I was told in advance to do it. So I had my little PowerPoint presentation, and my little PowerPoint presentation said, here's what you do. You have now, remember back then homes were $180,000. The average median price home was $180,000. So I said to the Fed, I said, here's what you do. And this is when they were this is pre-TARP. This is like while they were still arguing about all that crap in Congress. And I said, so my presentation was to say, here's what you do. There's 2 things to do. I said, first of all, we create jobs because there was a job issue. I said, you create jobs by putting solar rooftops on every viable home in America so that you lower people's electric bills and you put it into their mortgage, which is something that's kind of happening now, but the government isn't doing it. But I said, I was like, it's not optional. You say every home in America shall now have a solar roof, and therefore we're going to put 5-10 million people to work installing solar roofs and working with the solar roofing companies and so on and so forth. And we would have drastically cut down because we had to fix the electric grid anyway. We still haven't fixed it, by the way, but we have to fix the electric grid anyway. So that was going to cost trillions of dollars to fix the electric grid. So I'm like, well, if we do this, we'll reduce the pressure on the grid by about 25%, and we won't be under so much pressure to fix the grid, and we can do it over a longer period of time, and it won't be so expensive or impactful. That wasn't my suggestion. That was my alternate suggestion as far as something else that the government should be doing. But my main point was, here's what you do. You make a one-page form at the bank where you have a mortgage. And if you're a homeowner, you sign over this one-page form and say, essentially, the government will put $100,000 into your house, and it will become the primary, oh, I forgot the word now. The person who lends you the money. It'll become the primary lender, I guess. I forget what there's a word for it. Anyway, so they'll supplant the bank, but the bank's going to have these forms. They'll supplant the bank as a primary lender. The bank becomes your secondary mortgage. Oh, your primary mortgage holder. That's it. so the government becomes your primary mortgage holder. The bank takes secondary. Now the bank's going to do this because the banks were worried about they couldn't foreclose on everybody anyway. This is why we had to bail out the banks. The banks were screwed because people couldn't afford their mortgages and were walking away from houses. So I said, here you go. You sign this piece of paper, and it says, the government is now going to be my co-owner of my house, or the government's going to pay $100,000. All I do is sign my name on a piece of paper at the bank. They identify me, of course, as a homeowner. And my mortgage then is reduced by 50%, 30%, whatever it is. My mortgage payments are now 50%, 30% lower. Because the bank can afford to, the government can afford to be patient and hold the mortgage until it becomes worth something. In any case, they're going to get made whole. Oh, also they would participate in a portion of the increased value of the home, like 25%. 25% of the increased value of the home going forward would belong to the government. They're essentially co-owner of the house, or whatever. Or I think I said it would be proportional to the value of the home. So depending on the value of the home. But meanwhile, the point for the homeowner is your mortgage gets reduced by 30%, 50%, whatever it is you have on the house. Suddenly your mortgages get cut in half. So if you owe $200,000, now you only owe $100,000. The bank is now your co-owner. But they get paid ahead of the bank. That means the government say you're co-owner. It's just, now, it's exactly like what they did, except the government gave the bank the money and kicked the homeowners out and said to the homeowner, screw you don't have the money, pay your mortgage. Well, we'll get somebody who can. That's effectively what the government did. So rather than help the people and let them relieve the people who live in the homes, the banks would still get their money. They would still get being made whole. But what you'd be doing is allowing the people to retain more of their income and be able to manage their payments more effectively. You're effectively giving people $1,000 a month off their mortgages. That was what I proposed a solution. And they liked the solution a lot, but they basically said to me, it's not going to work because the Republicans will never go for it. They said they can never get it through, they'll never get it through Congress. That was why they couldn't do it. Not because they didn't think it was a good idea, but because they said Congress will never approve this. But instead they approved giving the banks the money. And it's the same freaking money. So helping banks, thumbs up. Helping people, thumbs down. Fuck them. That's America. It was unbelievable. Incredible conversation. Great. By the way, Tim Geithner, one of the smartest people I've ever met. And he had his smart people around him too. There's a really great bunch of guys over there. Thank God, because we would have been, had we not had that group in charge at the time, I don't know what would have happened, frankly. Because they were trying to protect the people, but they were also just being realistic about what could and couldn't be passed. Anyway, so that's what happened. So we threw money at the problem. We gave the banks more money for all these homes. And so the banks were made whole, and we kept the thing going by money printing, which is what you just said. And the removal of the gold standard was Nixon's original sin back in 73, 71, I think. Yeah, 71. That was the original sin of the currency. But the, with the growth of the economy, it was not realistic to have a gold-backed currency. But the way we did it was to just totally throw it out and just print money. So ever since 71, you can see what we've done. And then Phil says, do wages catch up, or does a housing crash, or both? It's going to be both at this point. Because again, like I said, think about your budget. You got $70,000 and a house is $450,000. That's your family income. You got 2 children and they got to go to college for, it'll probably be $500,000 each. My kids are in college now, it's $300,000 each for 4 years of school. Maddie has to go to graduate school. I knew that, but I mean, she's got to go to graduate school because she said she wanted to be a psychiatrist. And I said, fine, sure. Sure, you do that. I told both of my daughters when they were 18 years old, when they were graduating, I said, I've got 300,000 put away for your college. It turns out to be it's the right amount of money. And I said, but I'm telling you now, I will strongly suggest that you just take the money and open a business. That's what I told them before. And then COVID hit, and I was so right, because they weren't even in college and they were still paying the money. It was a total waste of money. But now, I mean, now they're, now they're back at normal school and getting something out of it. But I mean, 2 years of not even going to school, of taking classes on your laptop, and that's exactly what I told them in before COVID. I told them before they started college, I'm like, you can learn anything you want by reading books and going online and taking education. There is no reason for you to go to college. It is a waste of 4 years of your time. The only thing you'll get out of it is a social experience. They didn't even get the social experience for 2 years. So annoying. Eric says his son wants to go to law school. Like, oh. You see what the problem is? You go to law school, you come out of money, you come out of college, 2 years of law school, whatever it is, 3 years of law school. You're coming out of college, $450, it's like $500,000 to go through law, to go to college and go to law school. It's a $500,000 project. So if it's your money, okay, whatever, hopefully he does well. But if it's his money and he's got to borrow it and go in debt, then you're immediately going to be in a position where you're going to compromise your morals for money. How do you not, with this crushing debt from day one? Both of my kids, they kiss my ass because they understand what we did. I mean, they're like, thank God you paid for our school, because they have friends who are sitting there borrowing and borrowing and borrowing and borrowing, and they can't even, like, the pressure to get a job and the pressure to do something, as just for these girls, well, my friends are friends of girls mostly. For these people though, who go to college and they come out $300,000 in debt, and even with student loan being mellow about it in the first couple of years or whatever, the bottom line is you got to pay this money back, and then you've got to find the money for the house within 10 years. When you're 30, right? By the time you're 30, you should pretty much be having a house, right? House and then a baby. And I think a baby, oh, here you go. Let's do that. So you can see what's fun about AI, right? What is the average cost of raising a child in the US? $1 million, I think, per child. Mm-hmm. Huh. 233. That's not bad. Okay, I don't mind that. Why did I think it was $1 million? I guess that's including college. So until 17, that's not even not finishing high school for some reason. I guess that's when they get pregnant and drop out. So 300,000 to raise a kid. So this is where you are. So you come out of college, you got $300,000 worth of debts. You're 22 years old. You want to buy a house in 8 years. That's going to be another $500,000, even if you're going to buy it with somebody, hopefully. But then if you're buying it with a husband and you plan to have a couple of kids, that's another 600,000. So that's three. So you haven't come anywhere close to paying off your debts. You got 300,000, and then you've got half a house. Let's say you're splitting it with the husband. So it's 300, 500,000. Let's say you paid off a little bit of it, and then you get a couple of kids, and now you're half responsible for the kids. So that's 800. That's $1 million. That's where you come up with $1 million. But so there you are, and then you've got to save for the kids' college, and there you go. That's your life. Then you die. Have fun. So you think people are pissed? You think workers are going to keep taking this shit? But the problem is, it's like corporate taxes. We have to address decades. And that's why they go, oh, it's not fair. How could you tax us? All of a sudden you want to tax us like mean people. And the problem is that, shit, hang on, I can't see with this thing. So here's the problem. And I mean, is this big? I mean, oh. Okay, as a share of GDP, corporate taxes in 46, in 55, until 55, they were 5% of the GDP. That's on this chart anyway. Whatever the number is, they were 5% of the GDP. That would be currently, actually, yeah, there you go. So currently we have $25 trillion GDP. So that means it would be $1.25 trillion. No. Yeah, that's correct. $1.25 trillion. There you go. So we have since 1980, thank you, Reagan, been taxing them 1%. Okay, and you can see that. And you can see that here, there's corporate taxes, $442 billion. That is 1.5% of our GDP. Right? Because $250 billion would be 1%. Yeah, that's right. Okay, so that's 1.5% of our GDP. So how much are we not taxing them? We should be taxing them 5% of our GDP. So, so 25 trillion times 0.05 is 1.25 minus 440. Oh, 44.4. No, damn it. Okay, $125 trillion. That's gonna make it work. Minus 442 minus 808, right? So that's what we're not taxing them is 800 billion a year. How long? Since, where were we? Since 1982. So what's this year? 2023. So that's 20 and another 20, 40 years. So times 40, $32 trillion. How much is our national debt? $32 trillion. That's where the debt is. We didn't charge them $32 trillion. Now we're $32 trillion in debt. Very, very simple concept. The thing is that now they turn around and say, well, why do we have to make up for it? Or it's not fair, it's disproportional. No, it's because you're the ones that got the goddamn tax break. They got all these gains. They got the extra $32 trillion. They didn't pay the taxes. That's what happened. Oh, we should see that somewhere too. Oh, what happened? Oh, here it is. I'm sure somewhere there'll be a thing that shows the personal taxes must have made it up. Top marginal rates. Oh, there you go. Okay, corporate taxes, remember that, right? And that's a share of federal tax revenue. It's the same concept, share of federal tax revenue. 30%, not even 10% now. Who made up the difference? Payroll taxes. Used to be 10%, now it's 40%. Individual taxes are the same. You know why? The same people, these guys are individuals too. So they ain't gonna pay more. And the top, and believe me, the share of the top percentile people, I bet that's a chart too. Let's see. There you go. Yikes, top marginal rates. So the top marginal rates for income used to be, this is what, 80%. Imagine that, 80%, 70% from the Depression. See the 20s, right? They cut the rate, and what happened? They collapsed the economy. They cut the rate for all these fat cats and corporations. And see that capital gains, right? That's why everybody's playing the market in 29. Capital gains was the cheapest thing you could do. So they cut the rate, and capital gains is still pretty cheap. They're going to change that. But they cut the individual income taxes of all the wealthy people. They cut the capital gains rate to literally to nothing, from a lot to nothing. They spurred a market rally, right? Of course, everybody's buying stocks because it was the greatest way to invest, to do with your money. You weren't getting taxed on your income. You weren't getting taxed on your stock gains. Why not, right? That led to a total collapse of the economy. Then Roosevelt comes in and says, well, this was stupid. And he starts raising it back up. And they went further and further because they were trying to get, then we had a war and so on and so forth. So they raised taxes further. But generally, back to 70% until Reagan, right? Reagan says, oh, no. Let's go back to that. Let's go back to the Hoover times, right? Drops it. And then well, this doesn't really even illustrate the crash, but that goes down, corporate's down, capital gains is down. Suddenly the government has no interest in collecting money. And that's why we're $32 trillion in debt. All that is just rich people not paying taxes. And now you go to rich people and say, you guys got to pay some taxes now. Oh my God. That's why they're rich. And especially the people with the generational wealth who don't want to pay their inheritance tax. And they go, oh my God, this is how you got rich in the first place. And they're basically, they're just saying, we refuse to pay this. It's not fair. Why should we pay? That's the problem, is you should have paid for the last 40 years. And you're not even going to come close to making up for it. So it's messed up, and it's pretty unfixable. I mean, honestly, without a complete revolution in this country and a change of government and change of laws, and also, I mean, I'm talking massive changes. We're just going to keep going off the cliff. We're going to go further and further into debt because, it is too late. You could balance the budget going forward. I mean, there are things you could do, but I mean, it's getting unreachable. It's getting unfixable, especially because we also need to spend $2 trillion a year on the environment. We need to to do something about global warming. We need to fix our roads. We have a $4.7 trillion infrastructure spending that is not being done. That's critical stuff like bridges and dams and electrical grid stuff. Is $4.7 trillion of projects that need to be done around this country, and many of them are beyond critical. Tunnels like the New York, the Lincoln Tunnel in New York is literally every day they have to stop it from collapsing. They have to just constantly patrol and do emergency work all the time on these tunnels. They've got, fortunately, the design of the tunnel is it's got several tubes. I think it's got like 4 tubes. One or two is for trains. There might be 5. There's train tubes, and then there's car tubes. And yeah, I'm sure it's got to be 5. So they've got all these tubes for cars and trains, and so what they do is they rotate shutting them down. But there's always like one-off service so they can work on it, and then they open that back up, then they got to fix the next one, then they got to go back up. But it's like whack-a-mole. It's just constantly being fixed because it's a 100-year-old tunnel. It was never supposed to last 100 years. It is insane. It's a 100-year-old tunnel that's under the Hudson River, and it's in the mud and stuff. It's not in the middle of the water. It's under the mud in the Hudson River. But there's a lot of pressure, and it's constantly wet all around it, right? And it's under massive amounts of pressure, and it's being vibrated constantly by cars and trucks going through it. When they designed it, there were no such things as giant trucks. So that's a problem too. Buses and trucks is a big problem for it too. It was never designed to take that kind of punishment. So anyways, that's gonna fall apart. But that's not the only one. But that's just an egregious example of something. Then they have started work on a new tunnel because, or at least they're moving forward with the project because there's no way it's not gonna last. It's not gonna last 10 more years. They just rebuilt the Tappan Zee Bridge in New York. That's not even a bridge you think about, but it's, if you go past the Washington Bridge at the top of Manhattan, another 20-something, 30 miles up is the Tappan Zee Bridge. No, I'd say 20 miles. The Tappan Zee Bridge. There's another bridge way up there. That one had to be completely replaced already. The Washington Bridge needs to be replaced, but logistically, it's beyond a nightmare. There's like 1 million people a day go over that thing. You can't even shut it down. You can't restrict it. You can't, no matter what you do, it's a complete catastrophe. Even if you start building a bridge next to the Washington Bridge and don't close the Washington Bridge, first of all, what you end up doing is now you're paying for the repairs on the Washington Bridge and you're paying for the new bridge. And you know what's going to happen? Everybody's going to slow down to look at the freaking construction, which is what happened on the Tappan Zee Bridge. But the Tappan Zee Bridge is like, very almost no traffic compared to the Washington Bridge. If people start slowing down to look at the construction the way they did on the Tappan Zee Bridge while you're building the new Washington Bridge, forget it. So it's actually one of the reasons I left New York. I was like, this is just going to fall apart. It's just crazy. Anyhow, all right, good. So that's way over my time limit. I hope I answered everybody's questions on whatever the hell I was talking about. It's a wide-ranging discussion today. But anyway, so we're going to be careful. We got all the bank earnings coming out. We'll see how things go. And by next week, we should have a better handle on what's going on. So, just to say based on 20 earnings reports, we know what's happening is bullshit. All right. But the beige book, not so catastrophic. We got through the crisis. We're okay. The government spent a ton of money, but what else is new? So we're just another couple of $1 trillion in debt. No biggie. Nobody's going to pay for it. That's normal. No, everybody's going to refuse to do anything. And we'll see what happens. But what I'm more concerned about is how the rest of the bank earnings come out and how the regular earnings come out. That's what I was writing about this morning. I'm worried about that the gap on the S&P, the PE ratios of the S&P from this crisis are going to be moving the wrong way significantly. And we can't afford that. Also an unsustainable thing, but nothing anywhere near as unsustainable as the current income to housing ratio. That's the most unsustainable thing. But things like that take a while to unwind. I think honestly, you want to like invest in bigger homes because people, that generational family. Oh, that's the other thing. Oh my God. I think I wrote about this the other day. I'm sure I mentioned it somewhere. Nursing home prices, for managed care facilities have also gone completely insane. Labor shortages and everything else that's going on. I think it's $55,000 a year now is the average price of a nursing home. $55,000 a year. So I know there's like ways it works. Like as far as I understand, I haven't even looked into this myself, but apparently they take the Social Security check, right? So that's 2,500 a month. So right away that's half. But then there might be some aid and so on and so forth involved, and then the family kicks in the rest. It's more money coming out, more money down the drain for people who are trying to put kids in college and stuff. Now you got to start paying money for mom's nursing care. Oh, it's horrible. Oh, that's bad for Genworth. That's also, you got to worry about Genworth because Genworth has all these policies. That's their main business used to be. They have all these policies for guaranteed care. In fact, my mom, that's why I never worried about the nursing home. My mom's got that insurance. I've always paid for that. It's funny because she's 83 years old now and she never used it. So it seemed like a good idea to have a policy like that, but now every year that goes by that she doesn't use it, it's sort of wasted money. But God bless her. I mean, as long as she can stay out of a nursing home, I am very happy. But yeah, so Genworth insures that, and now you've got people who used to obviously not live so long. They can spend many, many years in a nursing home, and these prices of nursing homes are nowhere. There's no way they could have anticipated these kind of prices. So they're going to be in big trouble, and other companies that have managed care insurance are going to be in trouble. Pension plans, things like that. There's a lot of people who promised that they would take care of people in their old age that are just simply not going to be financially able to keep those promises. All right, and on that note, thanks for coming, everybody. I appreciate it, and we'll see you guys again next week. All right, take care.